We're very fortunate, as I said, to really be able to welcome Dan Barile here this evening. And I'm not going to have much of a by way of an introduction, but Dan is a senior portfolio manager at SkyBridge, where he's responsible for portfolio management, research, and diligence across a variety of alternative investment strategies. So it's quite apropos for him to be here for us tonight, and we welcome him. And so, really, without further ado, or much more of an extended introduction, I'm going to welcome Dan to come on up and take it over from here.
Cool. All right. Thanks. Thanks so much, Tim. I'm gonna. I was gonna say. Oh yeah, you got a microphone in there, right?
You're welcome to project.
I think I'm just gonna sit and I'll project. Yeah.
I got one.
Oh.
It's like a little.
Just put it in my foot. Yep. Thanks so much. It's on. It's on now. All right. Cool. All right, thank you, Tim. Thanks, everybody, for joining us. If there are any like Anthony super fans here, I apologize. You know, I will not be. I will definitely not be as outspoken as Anthony on anything. I promise. And we will not talk about politics at all, really. Which I know a lot of people are always excited to hear from Anthony on politics, and he has extremely strong opinions and will, speak his mind, as everybody knows. But I will give you a sense for really how we're, some folks in the room are probably not familiar with SkyBridge in any detail of what we do. They may know Anthony, so I'll just provide a really brief overview of SkyBridge and what we do, and what our mandate is from an investment perspective. Talk a bit about how we see the world today, how portfolios are positioned, and talk about some of the markets that we're excited about for 2022. So really an opportunity set. So my conversation will be, maybe more like the typical type of conversations you have in the alternative investment roundtable. So it'll be more focused on kind of markets and alternatives and our view of the world. I would love to kind of tilt it a bit toward crypto, because I always find that that's interesting and can be polarizing. And with a group this big, that means there's definitely some people here who love it, some people who hate it, and you can tend to have a kind of interesting discussion around that. And that's an area where we have been, as anybody who follows Anthony, who follows our firm, you see we've been increasingly vocal about how excited we are about that space, and how we have increasingly devoted both capital and resources to to investing in both crypto directly and also the crypto ecosystem. So we can talk a bit about that as well. My colleague Melissa Gottlieb is here as well on our investor relations team. So feel free to, if anybody, after I talk about SkyBridge, if anybody feels very excited and wants to invest in our product, feel free to walk over to Melissa. As Tim mentioned, I'm a partner and senior portfolio manager at SkyBridge. I started my career in 2004 at Merrill Lynch Investment Managers, the business that is now part of BlackRock. We sold to BlackRock in 2006. I ultimately ended up at Citi's hedge fund business, which, as any folks who have followed our history know, that was a business that Anthony acquired from Citigroup, post 2008 financial crisis. So current SkyBridge is really a combination with the SkyBridge that was founded in 2005 by Anthony to really do hedge fund seeding, private equity style investing in asset managers. That business combined with Citigroup's much larger hedge fund business in 2010. And so I've been at the firm for a long time, so 12 years now. It's incredible to sail out. We have been, what has always been unique about our approach is we're very kind of top-down driven, and we tend to run thematic portfolios, and we'll get concentrated when our research gives us conviction. That's always been our differentiator. And when you're right, when you're right and you're wrong, right? You feel it both ways, right? So I don't think anyone who's followed us over time can ever say that we didn't have an opinion and we didn't express it in a meaningful way, across our portfolios. So the firm today is about $3.5 billion in AUM. We are we really invest in two buckets. The way I think about SkyBridge today is you have the fund of hedge fund business, with most folks associate with SkyBridge. That's still the largest part of the business today. And we run several multi-strat fund of hedge funds with go anywhere mandates, so cross asset, cross geography, cross markets, right? Cross strategies, I should say. But all the newer stuff that we've done at SkyBridge over the last 4 or 5 years now or so, 4 years really, I guess, has been really direct investing, right? So we started like this evolution that you've seen a lot of allocators, evolve their firms over time. We are now active direct investors, started with real estate, but today, started real estate in 2018. Today, it's real estate, it's public equities, it's private equities, and it's crypto in a major way as well. And those are, funds where we are, we're no longer an allocator, we're directly, investing in those markets. So kind of I think a progression that you've seen a lot of, what you would classically call funded funds or allocators kind of evolve in this way. The most kind of obvious first step for most is co-invest deals. We've gone a lot further than that, right? So it's not, those private equity deals that we're doing are not just co-invest deals, right? I think those are interesting deals that we're sourcing independently of our managers, which is an important distinction as well, right? So it's not like, we have exposure to, pick your favorite, equity long short hedge fund that, has an interesting idea, and we say, yeah, we like that so much, we want to do a co-invest. It's more like we have a dedicated effort to like, hey, we have certain segments of the market that are interested, we're trying to participate in primary deals, and we have companies that we're interested in. If we can, if there isn't a primary deal available, we're going to try to source it on the secondary market. So very, very active dialogue with the broker community on the private equity side to source names that we're interested in on an ongoing basis. And so, that's definitely differentiated, right? It's not this like passive approach where it's like, one of our hedge funds on the funded fund side gives us an idea and then we just allocate to it. Very kind of active, direct investing effort. So that's what, if I could leave everybody with it, and this is one of the things like in the marketplace right now that we are trying to get the marketplace to appreciate, right? Because everybody knows that us as an allocator and a funded fund, right? I think there's less appreciation of all the new stuff that we've done and how exciting some of that stuff is. So, I would encourage everyone, when you think about SkyBridge going forward, it's not just that classic funded fund business that is still, that we're still excited about and actively allocating, of course, right? But also all the new stuff that we're doing as well. So the firm today has evolved quite a bit, right? So like I understand Anthony has spoken here multiple times over the years, even since the last time he spoke at one of these roundtables, right? A ton more kind of activity on that direct investing side of the business. So I think that's very exciting. So in the crypto space, especially today, we run 5 private crypto funds. One is a actively managed hedge fund, and the others are more passive access products. Super exciting space. I'll touch on that when we talk about markets more broadly. But hopefully, I would encourage folks as I start to talk about our view of the world, and if you have questions about what we're doing or our portfolio, just kind of throw your hand up and ask questions. Try to keep it, interactive. Especially with the crypto, there's been a lot of news lately that if you don't, one of the fascinating things about this space is even in a room of sophisticated people, right? There are still folks that have no idea how it works, the most basic aspect of it, like Bitcoin, right? And how does it work? How does blockchain work? How does the ledger work, right? And I had a big group yesterday I was speaking to, and we literally did I thought we were going to go here high level, and it was like a Bitcoin 101 type conversation. We never got to the advanced stuff. But I'm sure there's someone in this room that has a really strong view on UST and Luna and Do Kwon and what happened and all that stuff, right? So we can feel free to throw both those kind of questions at me, and we can talk about some of that stuff if it's interesting to the group. And also, there's all this other stuff, right? That like, even if you're not, and you're starting to see this like trickle into the mainstream, even like sell-side research, right? Where like, even if you don't care about crypto, if you don't have a crypto allocation, right? Like it matters. There's probably some folks in the room that like JP Morgan does this flows and liquidity report every week. It's like a lot of people read it. It's excellent work. And like even today, right? Like they've been covering crypto for a while, but they cover it from the perspective more of a traditional market allocator. Like why does this matter to everything else, right? And like if you don't think crypto matters, like check out that JP Morgan report today because it was great. Like this is where it gets really nerdy and boring and most people don't care, but like there's another stable coin called Tether, right? Tether owns a ton of commercial paper, part of their collateral for backing their reserves, right? And like JP Morgan in a great way, nuanced way, kind of unpacks this and they're like, hey, who's been a seller of commercial paper of late? It's been Tether out of reserves, which is actually really interesting because there's been a shortfall of available CP for traditional money buyers, and this alleviates some of that, right? So like, even if you hate crypto and you think it's silly, like it is big enough now where you have to understand it, and you have to understand you definitely have to understand how stablecoins work, how Tether works, how USDC works. You have to understand how Bitcoin works. You have to understand how ETH works. Some of the rest of it you can say is silly, I don't want to know about it, I don't care, right? But we're definitely at that point in markets where like this stuff really matters. Cross market, cross asset, right? You can no longer just put your head in the sand, right? So that's really, really interesting. Hopefully there's some questions and dialogue on that. Coinbase is another interesting topic, right? Like we're across our public equity funds where Coinbase is a high conviction position, top 5 position across all our public equity portfolios. We're a client of Coinbase as well on the private fund side. So we have obviously views there as well. We're constructive on the company despite the recent headlines and kind of, I would summarize it as poor management communication around that disclosure last week that caused a lot of uncertainty. So happy to talk about that as well. But take a step back first. So just high level from a market positioning perspective, right? And just our view of the world right now. Treacherous environment, right? So like anyone who's active in markets right now, like you have, there's really been nowhere to hide so far this year, right? Like, well, you could hide in energy, right? Like energy or energy equities or like, commodities more broadly, right? Hard to put on in size in most ways, like if you're talking about ags or other things like that, right? So like you've been able to hide in energy, precious metals have held up like okay, right? In relative value terms, they perform great, but absolute return hasn't been anything special, right? But everything else has been clobbered, right? So like you've got, NASDAQ now down 25%, plus. You've got S&P approaching down 20%. You've got, the Barclays Ag 10 plus, right? So it's like, it's been brutal, right? You've got investment grade bonds down, I think it's mid-teens now. So really, really nowhere to hide. And of course you've got growthy equities, right? Like pick your favorite, high growth, no earnings, company, right? The Cathie Woods type names, right? Who have just been demolished, right? I mean, you're down 70%, 80%. Fascinating environment, right? Like we were talking on the desk about this yesterday, and in a weird way, like this would be interesting to just kind of, as we start to talk, the group here, just to get the sense for kind of the room here. But it's like really bad, but it doesn't feel, I don't know, it doesn't feel as bad as like the numbers actually look, right? Like this has been a brutal, brutal start to the year, like really bad, right?
If I can kick it off by asking a question, what about, are your clients happy with what hedge funds have been doing in their portfolio?
So great, like high level question. So this has been like a year of, you got a lot of dispersion, right? So I think you have certain strategies have done really well and have done exactly what you hired them to do. So think like 0.72 or Millennium, like superhuman, right? Like, wow. like delivering, minimizing vol, and actually like did, for folks who may be familiar with those are called allocations in our flagship fund of fund. You know, even posted positive numbers last month in a brutally difficult market, right? Now the other side of that though is you've got, you know, some exceptional equity long short growth oriented managers, you know, guys that have been around doing it for a couple of decades, right? Who, you know, we've had money with for a long time or have known for a long time, generated huge alpha over the years, right? Like there was no ambiguity to like, this is real alpha and there's real value added from stock selection here, who have been demolished in a way that, like, you know, it would have been, it's very, very hard to wrap, like, wow, like how did that happen? And now it's regime change, right? It's not, their process didn't change. But like, I mean, I'm thinking of a manager in our biotech book, like arguably, if you look at like from an alpha creation perspective over the trailing 10 years, off the charts, right? I would say arguably the best fundamental biotech investor out there, right? But like anyone who follows markets, it's not like biotech is being crushed in a way that just look at the ETF and look at it relative to just about any other sector, right? And so that manager, right, has gotten caught up in that, and so it's a really difficult. That's a really difficult decision as an allocator, right? Like you think, like, wow, all right, so these are managers who have done a really good job over time, but you've had this violent kind of regime change where growth is out of style, right? And anything growthy or more speculative is out of style, right? And so it's really tricky because those managers are on the other side of it, right? Where if you said, hey, even in a choppy market, I might expect that manager to be down 15 or 20%, they be down more like 30 or 40%, right? Which is really, really difficult, right? And then interestingly, and you've got traditional strategies that are more defensive that have held up really well this year. Haven't really made money, but have been defensive, like Convertible, for example. Most credit managers have done pretty well, so like have hung in there pretty well, made a little bit of money, right? So that's corporate credit, but also structured credit, converts, multi-strat. These are strategies that have done, you know, relatively well. I would say equity long short broadly, and keep in mind that the hedge fund world, equity long short most of those guys tend to be more growthy in nature, in their orientation. It's been really, really tough, right? And so like you've got some managers where it's like, okay, if you don't have some normalization, right? You don't need like everything to swing back to growth being back in favor. And I don't think that's gonna happen, right? But I think it's overshot in a major way. Like growth equity investing is so out of favor right now. Like this was in the FT the other day, like Vanguard's forward 10-year expectations for growth equity expected return was 10 bips. It's like stupid. It's a stupid number, right? For like, does anyone really believe that? But like, that's where we're at right now, right? Where it was so good, now it's so bad, right? And now you've got the strategists that are, updating their numbers, and it's like, all right, growth's not going to make money for the forward 10 years. Like, that's not going to happen. Or, I mean, of course it could happen, but we should all be braced for an extremely difficult forward 10 years, right, if that's the case. So I think we're in this limbo right now where it's probably overdone when you think about the most growthy stuff, right? Like, it's hard to see much more pain there. But then you got certain segments of the market that have held up really well. So this is what's interesting when you take a step back and think about the macro environment, right? So like growth stuff has gotten smoked and destroyed, right? But then it's like, hey, if you own a portfolio of like high quality dividend yielding stocks, like you actually held up really, like you held up decently. You haven't made money, but you're kind of like flattish on the year, right? And that portfolio would also be tilted toward energy names as well, which is part of the reason that it's like pulling it up. But I would say in general, like more value oriented names, even away from energy, have held up really well, right? So I guess that's another place you could have hid. But like, it is really interesting because I don't know, even if you say like growth's oversold, and just, you have to talk about crypto in this conversation as well. Crypto has held up, high quality crypto, so by that I really mean like Bitcoin and ETH, right? And this is, if you're not really in tune with this market, this may not be appreciated, but has held up like remarkably well. Anyone who follows Bitcoin and follows how it interacts with other segments of the market, right? Like we were having this conversation on the desk this morning, myself and our co-CIOs, and it's like, wow, if you had imagined a world where it's January 1 and all these things happen, right? Kathy Wood's portfolio is X, NASDAQ is down X, right? Where is Bitcoin? Any reasonable professional investor would say Bitcoin could have cracked 10,000, right? Like Kathy Wood's portfolio is down 70. Bitcoin's hanging out around like 30.
It's actually, last 6 months, I opened it up, it's about 50.
What's that?
Bitcoin, off its high. 48.08% off its high.
Well, it's absolute highs.
Yeah, oh yeah, no, totally, yeah, the high 67 in November.
So I don't know if that's hanging in. I mean, it's hanging on maybe, but.
Well, no, but think about it, right? So, this is my point with, if you said growth equities are down 70, most people, if you're a Bitcoin skeptic or a Bitcoin bear, you said Bitcoin's down 90. Bitcoin's 5,000. That's my point, right? So Bitcoin is my bigger point. I take the point, sir, right? Bitcoin has had annualized vol of 90% a year. Down 50 is no surprise to anybody who's a serious investor in Bitcoin or digital assets. Like that's within the realm of normal expectations. The bigger point is like, wow, like growth stocks are down, have been hammered like that, and Bitcoin has like held the line. Now, more speculative crypto, to be clear, totally different story. So you got some names down 80, 90%, right? And I think it's going to be a while. I think that we're in this period right now where it's going to be a while, I think, before you start to see interest in kind of lower market cap, more speculative, assets in crypto. But like, even coming into this month for the year, like Bitcoin was down like 7, again, it cracked this month along with everything else, and that ties in part to what happened with UST and Luna, and just kind of de-risking in crypto broadly. But like Bitcoin was outperforming the NASDAQ coming into May. That's wild, right? For any serious investor in the space, you're like, that's kind of like a shift in how this asset is trading. Remember, Bitcoin got down to 4,000 in March 2020. 4,000, right? So like that again. So any serious investor, you're like, wow, you appreciate that Bitcoin can have these wild moves, right? And so the fact that it's been resilient is the right word in relative terms, right? And ETH to a lesser extent, but it's hung in there, right? And I think it's interesting, just given how difficult markets have been.
You guys are top down, and I guess the biggest fear right now with $110 oil is 1970 style stagflation.
Totally.
So everybody's like looking at numbers there. What's your reaction to something like Walmart the other day? I've never seen Walmart down 10% a day.
Oh no, it's in Target, 25%. Yeah.
Years of it's never seen Walmart.
Yeah.
A day. So what are you guys thinking when it comes to the broader economy, the earnings basically?
Yeah, no, look, so you think about like 1Q earnings, right? Like it's a weird time because it hasn't been like that bad. You've actually had, like, if you don't follow markets closely, like you'd probably be surprised by this number, like 75% have been beats for Q1. Like that probably surprises people when you look at what markets have done, right? But you've had high profile misses, right? So you have Coinbase miss, crushed, right? Netflix miss, crushed. Target, Walmart, right? And so people are like, whoa, and you look at the screen, you look at CNBC, and you're like, oh my God, what's that? Target's down 25%, right? So you feel it, right? But it hasn't been that bad. Like again, if you take a big step back, you're like, okay. And even like, the real economy, put inflation to the side for a second, right? Again, like this is not, the data is not bad, right? We have this issue, this inflation issue that is in a large part this supply side problem that is like impossible to deal with. That's the other big problem here as well, right? Because like we can't control that, right? you have wacky things happening with commodity prices, you have wacky things happening with supply chains, right? So you can't control China's shutdown, meaning like Powell can't do anything about that, right? And the same thing with commodity prices and the war in Ukraine and all these other issues, right? And so it's a wacky time because like most companies are doing okay, right? True, like factual statement, right? Even compared to sell side expectations, they're doing okay. But there's clearly like a lot to be concerned about, right? And so everyone, like we're all in this boat right now where you're like, I think any professional investor, if you're honest, right, you have to say like, wow, this has been this incredible series of events, right? You've got pandemic, you've got this crazy stimulus, you've got, this stimulus that resulted for sure, created some of the inflation, right? But then you got these wild card things that happen that are totally uncontrollable that you can't, like the Fed doesn't have the toolkit to control them, right? Meaning the supply side aspects of it, right? And so, and so you're so dependent on everyone, right? You're so dependent on like, hey, like, is the Fed going to be able to thread this needle, right? Like, is it, you could easily sketch out this situation where like, you get like core inflation under control, right? And then the Fed, like imagine they ease off, right? And like a couple of months from now, Powell's like, I know I said like 50 and 50, but it's only going to be 50 now, or it's going to be 25 and 25. And then at the same time, like China reopens and there's like positive news on Ukraine, like you could just see everything rip, right? And we're off to the races. Like, I mean, it could be a wild rally. Or you could also, like any reasonable person, there's no ability to predict any of this, of course, right? So like any reasonable person though, you have to give equal probability to like situation in Ukraine continues to deteriorate, right? China supply chains just get worse, right? And so the Fed just keeps, and the Fed sticks to 50-50 and then they have to do more, but you still can't get inflation under control because it has this like, meaning real inflation hidden, mom and pop pocketbook because you have this inflation and commodity problem and supply chain problem. That's that's that ugly scenario I think you're getting at, sir, right? Where it's like, there's nothing you can do. And that's where it's just, hey, be diversified, try not to have be diversified from a strategy perspective, be thoughtful, be high up in quality when you can, right? Like, to be clear, even like in an environment like that, we still maintain a lot of the positioning that we have right now, but we tweak it to be a bit more defensive on the margin, to be a bit higher quality, right? You definitely don't, you're just more cautious generally, right? But it's such a weird time because you can see the back half of the year, meaning like, I don't think any reasonable person can say like, it's totally risk off right now. First of all, it's not the mandate, right, for any professional investor, right? Like the mandate is not, hey, you have to make a decision and take risks, right? But it's like, even if you could, right? Like even if you had the flexibility to say, I'm going to go all to cash, like I don't know if that's the right decision because you think you could have this back half of the year that's a huge rally, So it's I have a super long-winded answer, but like it's
not simple.
It's not. It's a brutally difficult environment. I think any serious person has to acknowledge that, right? And like any person who's like pretends like they know what's gonna happen is like, those two scenarios I just sketched out, right? I think you have to give them equal probability. And then there's this middle ground where like, hey, we made these lows and we just plod along here, right, for a while, and then you're just in this period with a ton of trading volatility as well, right? Which is like, that's we were talking about on the desk the other day. Like this feels like one of those times, right, where you're gonna have a day that feels great, where everything's up a lot, and then you come in on Monday and everything gets crushed again, and then it's 2 days of sell off, and then it's drops again, and then 2 days, but you're just kind of bouncing around these levels for a while,
You mentioned biotech a few minutes ago. Two of the largest biotech funds, worth over $10 billion, got crushed they're being creamed again this year. And you would think when you look at their portfolios that since they're running more than $10 billion, they'd be invested in only large cap stocks. The exact opposite was true. Some of these funds had 180 different positions. And the juice was all in the small stocks. And as they bought, it just kept going up and up and up and up. And then it's time to sell. And what happens is what we refer to on the global macro side as the Roach Motel trade. You can get in, but you can't get out. And they're down, some of them are down over 50%. And they still hold these small cap names. And they're going to be forced to liquidate. Because if you're a pension fund, you can't go up in front of the board and say, hey, I gave so-and-so $400 million. And by the way, they've lost half of it. What happens to them in the next 6 months?
Well, I think you're right, sir, right? Like, yeah, you're gonna have these things, like that's how it always happens with these things, right? So some board is gonna end up firing some manager probably at like the low point, right? And then there's gonna be some epic rally, right? But you now can't defend, you were the person who championed that allocation, and now, the manager has destroyed all this value, right? So, or it's going to be a combination of manager and just that sector exposure, right? So I think it's tough, right? You could get in certain sectors, right? You could get bailed out by kind of a mean reversion, and it starts to kind of normalize, and then maybe those institutional investors make a different decision, right? But unless you think good biotech investors are real bottom-up guys, right, or girls, guys and gals, and they own those names because they have a strong view fundamentally, right, on this is, this is going to be some transformational event, this company will bring about or product. So that's most of them are underwritten that way, right? They're not trading oriented, right? And so, but that scenario you sketched out where you could have more pain, right, as you have the institutional investors, right? Like you've had the ETF investors have been able to, leave, right? But now you could see kind of a longer tail of, but a lot of that said, like, some of those managers, as you may know, have terms that are, not that mitigate some of the risk of like a disorderly sales of some of their assets.
Well, they can gate. That pretty much puts you out of business. They're trying to sell very small cap stocks that are now incredibly illiquid. And they're being forced by the pension funds.
So this is, keep in mind, alternative investment roundtable, right? Like this is like one of the interesting things about hedge funds more broadly, right? So like you mentioned using a gate, right? In a situation like that, if you own a bunch of small cap stuff that's been beat up, you have a strong fundamental view, that's the time, if you think about like what is your goal is making money for your investors, right? That's when you throw the gate up. And there are going to be some cranky investors, right? Like of course. But like that's probably if the goal is making money, right, that you throw the gate up.
Well, what are you seeing now? Are you seeing investors putting in redemptions? Are you seeing people wanting to put more money in because you think it's a good opportunity?
We haven't seen anything. When I think about like I would say even the managers that the growthy oriented managers that have had really really difficult really like Q4 last year into this year, right? From with a couple of exceptions, in general, I don't think you have not seen investors opportunistically adding, but you haven't seen investors like this. We're talking about hedge fund investors here. Hedge fund investors like hitting the exit door in a huge way, right? That is disruptive, or like 08-esque, right? If you think about what happened in the fourth quarter of 2008. To be clear, nothing at all like that right now, at all, right? But you definitely have, but you haven't also, there haven't been like, I can't think of anyone that's down 40 or 50 that are like, hey, I just opportunistically, I raised $2 billion because people are so excited about my opportunity set. that's not happening either, right? So, you know, I think if you were in an environment that had, if you had less macro uncertainty right now and you just had a sector get crushed, I think you probably would see some of that. So you'd have big ticket writers come in and say like, hey, I'm comfortable with the overall world right now. I'm willing to underwrite that, and like you're an alpha guy or girl, and like, you know, go for it. Now's not the time, right? You can't. Meaning macro environment is so uncertain. You know?
Can I ask? We came into this year. With really high margin levels. I'm wondering if you were. That was too weird. Really high margin levels. I'm just wondering. Obviously, through the GFC, we saw that there was that spiral down. That it's just selling at any price because brokers were like, "I don't care. You didn't meet your margin call. Just sell," and then that begat more selling.
Yeah.
I'm just wondering what you think about that.
So we haven't. Well, you haven't seen that in a major way, right? And again, like, you know, this is like, I hate to do this is like, you know, talking head TV stuff, right? But it's like, we all know the story, right? Like the consumer is in better shape than they were in 2008, right? Like in aggregate, right? Like less leverage, overall more liquidity, right? If you have any money, you're still, even with the sell-off this year, right? Like you're probably better off from a total wealth perspective than you were 2 years ago. Like if you're a person with assets, that's highly, highly likely. Of course, real estate's a big component of that, right? You got like Case-Shiller up 20% year over year, it's 18, 19, right? So it's, you know, their consumer is just in better shape. Generally, I think more liquid, especially the investor. If you think about the retail investor that's driving flows, and you strip out, you know, like the Robinhood crowd, which I think has effectively been shaken out of the market. I think most will agree on that, right? You know, you haven't. I think that. I don't really have the data to support this, right? But it's just like synthesizing everything, a lot of little things, right? I think the retail bias is like different than the institutional investor bias right now, where I think it's probably hard to prevent those folks from like buying the dip, you know, where they've also been conditioned to like, hey, just, you know, it just goes right back up, so just buy it, right? It was like, you know, 2008, of course, right? But then March 2020, right, was the best, like, and the world was literally ending. It was literally scary. It was horrible, and you should have just like, you know, held your breath and bought everything you could have bought, right? Which is totally, really, really, you know, like impossible to do, right? I mean, like really, really hard to do. And so I don't think, I think that, you know, and this is another, I forget, there's a sell-side report that was talking about this today, and it was really interesting. But you're talking about this idea of even, like you think about the end of this quarter, and like, again, this is like, you get super nerdy here when you talk about stuff like this, but it's true when you think about the big moving markets, right? Like just think about like if you're running a 60-40 portfolio or a target date portfolio, right? Like your allocations are off, right? And so now you're gonna like reallocate at the end of the quarter. You gotta buy a ton of equities. You're out of line, right? And the retail investor probably wants to buy the dip, and they probably still feel like they're better off than they were a couple of years ago, even if they're worried about the macro environment. Again, we're talking about like the investor class here, right? The folks that are going to drive mutual fund flows, right? I don't know. I think that, you know, I think that the retail investor is likely to be a buyer, you know, where maybe the institutional investor is more cautious. Does that make sense? You know?
Well, the retail investor is going to be much more influenced by inflation, and you know they're wondering about $7 gas and what's food going to cost in 3 months. So I don't think they're going to be rushing in.
I agree with to a point, though, right? So that's an interesting idea, right? But does the guy or girl with a $2 million 401k actually, you know, who's a professional in New York City, does that inflation, does $7 gas price actually impact his investment allocation decision? I don't think so.
I think that the retail investor of today is a lot more solid than the retail investor of 2008. And if there is going to be uncertainty and nervousness happening up with the retail investment, it's a little further down the road. I just have a two-part question.
Sure.
So I am cognizant of Bitcoin. I'm an old guy.
Yeah.
I actually started out in interest rate swaps when that was a new thing. That's how old I am. So I guess my two-part question is this. What percentage of the crypto transactions actually manifest in a sale for a tangible good? You know, buy a car, to buy a house.
Yeah.
If that is still low, extremely low, and it's speculation, and you get Matt Damon on TV during the Super Bowl going after the retail audience, is that laying the foundation for a Ponzi scheme?
So,
And I'm not trying to.
yeah, no, totally, no. So I'll answer the second part first, right? I mean, like, I think the timing of the Super Bowl commercial, like, could have been worse, right? Like, it's like, come on, you think about.
But it is that thing.
And they were all like, I don't know, they were all kind of silly commercials. I mean, the LeBron one and the Coinbase one I thought was the coolest, with just the QR code, Look, it's America, right? Those are companies that are going after a new market. Like, it is what it is, right? So, I don't think there's anything different or unique about crypto and that, right? You would have the same. You can think about other similar things that have happened over the years, right? But the question about, like, hey, what is this all about? I think that's the bigger question, sir, right? Like, how much of Bitcoin is actually used for transactions, right? So this is the fundamental, this is what, and there are some people, like, in the room who are just going to be like, totally disagree with you, like, I think that's a silly way to think about it, you're wrong, right? But there are a lot of people that what I say I think is going to resonate with, right? So, first of all, when you think about crypto, you have Bitcoin and you have everything else. I think this is important. If you're not deep enough in crypto, that's not fully appreciated, right? So you have Bitcoin, which the use case is alternative store of value, decentralized money. That's what it is. It has no other use case. It doesn't do anything. It collectively has value because we agree it has value. Now, again, people, some people like guffaw at that, but it's like, well, time out, right? Why is the Park Avenue apartment worth $25 million, right? And then you go downtown or you go to Brooklyn and the same exact footprint, same exact thing, nice neighborhood in Brooklyn, that apartment's worth $2.5 million. Because we collectively agree that Park Avenue and 63rd Street is much better, right? Like, why does gold trade at a premium to silver? And there would be people who say, like, gold has some utility value, but, like, no serious person says gold trades at $2,000 an ounce because it has utility value. It's because we collectively agree that it is more about, I'm not saying it doesn't have some utility value, right? But maybe it'd be worth $100 or $200, I don't know. You'd have to do the math. But the main reason that it trades at around $2,000 an ounce is because we collectively agree it has value. And then, like, why does think about the way markets work, right? Everything trades on multiples, right? Like, we all collectively agree that this X multiple makes sense for this company that of revenue that's never made money. And we're all comfortable, right? Professional investors, with 40 years experience in CFA charter holders like myself, right? You're like, yeah, that's cool. I can buy that company as an institutional investor, right? So, like, that's where, for serious investors, right, I think that's where you have to open your mind a little bit and say, like, hey, there's a lot of things that only have value or have significant premium over intrinsic value because we collectively agree they have value, right? Any serious person has to acknowledge that. Now, the big idea behind Bitcoin and what makes it different than everything else is Bitcoin is decentralized, right? So there's no central bank. You can't debase it. You can't change the inflation rate. You have 18.5 million right now. You're never going to have more than 21 million. So it's this really elegant, special idea where if you're like, and this is why it started like as this kind of fringe thing where it was like, hey, this is like a way, and remember, this grew out of the 2008 financial crisis, right? Like, this is money we, the people, control. right? And again, it's outside the scope of this conversation, but like this is what Bitcoin miners do, and the Bitcoin network is maintained by miners. Elegance, part of the elegance of design of Bitcoin is that the miners get paid in Bitcoin. The miners are the only ones who could ruin the network or do something bad, but you force the miners to invest massive capex and run in the network, and they get paid in Bitcoin. So if they ever did anything to ruin Bitcoin, they would ruin themselves, and they just invested massive capex in machines and data centers and everything else. So it's really elegant in its design. The largest Bitcoin miner in the world right now, as known, is about 5% of the Bitcoin network hash rate, meaning that it's also hugely decentralized and fragmented, the folks who run the network. So Bitcoin is this idea of decentralized money, alternative store of value, a digital alternative to gold. Right now, I don't. No one has the data, right? But like, I would bet you that 1 BIP of Bitcoin volume this year has been used to buy stuff. Like, but that's not the use case. It doesn't matter, right? And this is an important, because this is also another, I think, problem, because you had like the early Bitcoin evangelists, right? Where like, Bitcoin is new money. It's going to replace the dollar. Like, no institutional investor wants Bitcoin to replace the dollar. It's stupid, right? Like, it's dumb. No one wants that. Bitcoin, if you're a serious investor, is a part of a strategic asset allocation plan of everyone 10 years from now, 20 years from now, and it's 50 bips or it's 1%. And if you know how the mechanics of Bitcoin work, given hardwired scarcity, and you can't mint new ones, and the only way that you get one is to pay up for another one, you see this setup for the price to go silly, right, if it gets implemented in a big way across portfolios. That's why like Fidelity introducing Bitcoin into 401k as an option. Like, that's the little stuff that really, really matters, right? Because it's not just the incremental reallocation where, they have clients that allocate 1% to Bitcoin. It's steady Bitcoin flows from here to eternity, right? In every 401k plan that Fidelity administers, right? So the bigger idea here is that it's not in the same way that like you could be a gold bull, but like you're never going to buy a house with gold bars. You can convert your gold back to USD and you're going to buy a house. It was the early Bitcoin evangelists were just like, it's the new dollar, right? We're going to transact on it, and like you're going to be. But like, why would you do that? It's silly. Like, that's the thing. Like, now that said, you get in the weeds on this stuff, and there are interesting things being built on top of Bitcoin, like a company called Lightning Labs that is built on the Lightning Network. We're a small investor in Lightning Labs. That is meant to like facilitate transactions using Bitcoin in a like rapid, efficient way, and it's cool and it's interesting, but like. It's not, the big use case is alternative store value. And then you convert your Bitcoin back to your fiat currency to buy something. In the same way that you would sell your JP Morgan stock to put a down payment on a house, right? Like that's the big idea, that's like the way we think of it. I would encourage folks who are like skeptical of Bitcoin to think about it that way. And then you've got the rest of crypto that is so different than Bitcoin. Right? So like you've got Ethereum, you've got Solana, you've got Avalanche. People like conflate all these things. There's Bitcoin, alternative store value. There's everything else, right? When you think about like Ethereum, what you should think about is this is a platform for people, right, who have commercial interests, right? Not hackers, not some fringe, like people with commercial objectives that want to make money, to build things that are going to disrupt big tech in a meaningful way.